Statistical Analysis, Investing versus Trading Strategies. Please, Mr. Christensen, Mario, Frans.
Good morning. Hold on, let me change my background. So, hello. Okay, good morning, everyone. So, today I'm going to be presenting about the topic Ms. Vera just mentioned, and I'll actually be sharing screen right now. So can you all see my screen now? Hello.
It's okay.
Okay. Okay. So this is my presentation, and I'm doing this actually with a partner and my lecturer, which is Miss Nurul Nunung Qomariah. She's also attending the the conference at the moment. So to begin with, um, let's begin with an introduction of what the stock market is. So it is a place where people are able to buy and sell shares of publicly traded equities through an intermediary stock exchange or broker. In general, there are two main ways of generating profit in the stock market, and that is through trading and investing strategies. Although there are countless of methodological differences between the two, the main distinctions are actually between the time frames between their buy and sell trades. Traders often try to profit in the short term, such as intradays, whereas investors tend to pursue returns in the long term, usually holding their positions in their portfolio for years. In 2008, one of the most famous and successful investors, Warren Buffett, placed a bet against a hedge fund, Protege Partners LLC, saying that they're not able to beat the S&P index fund in returns in the next 10 years. Both parties competed against each other, and the one which makes the most return in the next 10 years wins the bet. The hedge fund analyzed and traded stocks comprehensively and ended up with a 2.2% average annual return. On the other hand, Warren Buffett simply invested in an index fund, which profited his investments by 7.1% on average annually. So, based on the fascinating results of this case study, we figure out that it would be interesting to statistically compare passive investing with multiple different trading strategies, profitability ourselves, and determine which is more profitable in the long run. Based on Warren Buffett's results, our initial hypothesis is that investing is more profitable than a compilation of short-term trades in the long term. Our research tries to prove if this hypothesis is true or false. So first of all, how do we get our data? For our data, we collected 10 years of market data for the top 45 Indonesian blue chip stocks in the present Indonesian Stock Exchange. In finance, long term refers to a period of time that's beyond 2 years. Therefore, we figure out that 10 years of backtesting or simulation results are enough to be considered as long term. The data is also collected using the Alvin Python API. And so next, there are also a few reasons as to why we're only using blue chip stocks for this study. First of all, these are well-established companies, and they are more reputable, fundamentally and financially stable. Also, their price movements are more consistent over the years, and also they have a huge market capital, and this also leads to the fact that they're less prone to impacts of market movers, such as pumps and dumps, and as well as their price movements are more impactful to the changes in the overall Indonesian stock exchange index. So, also additionally, some non-blue chip stocks are also listed after the year 2011, which is less than our 10-year paper trading period. Also, there are hundreds of non-blue chip stocks circulating in the market, so therefore computing for all of their returns will be time-consuming and inefficient for our research. Next, so what is our method? And so our method, what are our strategies that we're using? So first of all, for this study, we have chosen 7 different indicator trading strategies compared to a single buy and hold investing strategies. And as you can see here, these are the trading strategies that we're using. Next, so also the reason why there are multiple trading strategies, but there's only one investing strategy used is because traders actually use countless of different trading strategies to trade over the years. Therefore, it is to be as fair as possible. We need to compare the most commonly used trading strategies at the moment, and moreover, there are actually multiple of different investment strategies too. However, most of these investors do not worry about the time fluctuation of their stock prices, as well as only invest in company for years. Therefore, it is only fair for us to implement a universal buy and hold strategy to represent the investing strategy. So next, after we compute everything, this is the results that we get. So as you can see here, now we plot everything in the, we plot each of their average results independently into the following chart. And additionally, to make the results more accurate, we also want to add a separate plot within each chart and for each strategy as well. And that is to include the cumulative average trading or brokerage fees in Indonesia. And we get this data from the references, which I'll be mentioning later. So according to the source, the average brokerage fee is about 0.6 and 0.26% for each buy and sell trades respectively. So as you can see here, there's a significant difference when you include the fees. Returns. There's a significant difference in the returns when you include the fees. Sorry about that. Okay, so next, to evaluate the data visualization that we already did just now, as you can see, there's a major difference in the results between investing and trading strategies, indicating that different strategies do provide different results. Of course, there's a clear difference between the returns including fees plus, which I just mentioned before, indicating that it is able to cause a dent in our profits in the long term. And next, the investing strategy seems to have a clear difference between the returns and the returns including fees. And this is due to the fact that it does not place any trades in between, making the transaction fee constant throughout the trades, since it's a buy and hold strategy, right? And next, so to further extract more information from the graph we just plotted, we added another feature, which is linear regression. And using this linear regression, we're able to see the overall direction of profitability simply by examining the slope or the gradient. And we can actually look at it simply by our naked eyes at the moment. And we can see that there are some strategies that are making money in the long term, and there are strategies that are losing or barely even making money in the long term. So next, so as mentioned before, 5 of our strategies have a positive slope, and 3 of them have a negative slope, and indicating that not all of the strategies are profitable in long term. Secondly, for strategies with positive slopes, the investing and 2MA strategy stands out the most compared to the others, which indicates that they're the most profitable. Third, for strategies with a negative slope, we can see that the price to 2 moving average crossover has the lowest overall gradient, followed by the Bollinger Band strategy as the second least, and finally stochastic strategy with a really close to 0 negative gradient. Next, the 2 moving average crossover is also the only trading strategy with a larger gradient than that of the investing strategy. Therefore, it's deemed to be more profitable than that of the investing strategy. So next, to visualize the data even more, we want to compare every single trading strategies that we mentioned before, including the investing strategy, and we plot them into a single chart. So also these are returns, which includes the fees. And now that includes the fees. And Next, so as we can conclude from this chart, the differences between the cumulative returns for each strategy is also moving apart further and further away from one another as uh, the time frame increases. So overall, the two moving average crossover and the investing strategies are the most profitable strategies out of all. The investing strategy is also able to beat nearly all of our trading strategies. And fourth, the investing strategy generates a similar results like the two moving average crossover strategy. And this is because the two moving average crossover strategy returns outperform that of the investing strategy in about 50% of the time, which is specifically between 55 to 115 months if you look back in the chart. So, alternatively, the investing strategies returns also outperform the two moving average crossovers returns in about 50% of the time, and specifically between 0 to 55 and 115 to 120 months. So, next, to conclude even more, as shown in the chart before, there are a lot of tangles in the strategies chart, and they are making it for us to determine which is the best and most profitable long-term strategy visually. To address this issue, however, we should try to evaluate results using average annual returns instead, as mentioned in the case study before. Because the case study uses average annual return to calculate the metrics. So, as shown in the table on the left, we have the calculations for the average annual returns for each of the trading and investing strategies that we're using here. As you can see, the investing strategy, in fact, does outperform all of the other strategies, which are all of it are trading strategies, and therefore this satisfies and proves our initial hypothesis that passive investing beats active investing in the stock market in the long term. So, to conclude, upon some of our statistical and general lookups for the possible causes upon matter, we found the following reasons. First, investing ensures that you don't lose on the market's greatest days. Alternatively, it's also extremely difficult for a trader to predict the stock market. And secondly, trading frequently can rack up brokerage fees over time without much realization. And third, long-term investing adapts a concept of compounding interest, and it is when an interest earned on a principal balance is reinvested and generates additional interest. This concept helps to accelerate the growth of the money exponentially over long periods of time. Alternatively, all the trading strategies miss this concept as they require the trader to repetitively enter and exit the market. And so that's all for my presentation. Thank you very much. Is there any questions?
Yes. Thank you, Christensen, for your